It's fascinating that everybody's looking at these lagging indicators, to say, well, look, the economy is doing fine. They're looking at GDP and they're looking at employment. These things are all, classic lagging economic indicators. So if you want to look in the rear view mirror, yeah, things look great, right? But if you're looking forward, you're looking at leading indicators, all of them are pointing to not just the high probability of recession, but a significant possibility towards the middle or third quarter of this year of a pretty significant one.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Market uncertainty has returned as bulls and bears remain locked in a fierce battle for control at the S&P 4000 line. Who's more likely to prevail? And will 2023 provide a relief to investors over the beatings they took in 2022, or will it prove to be another bruising year? Researcher Jesse Felder has been tracking the macro and market action closely of late, and we're fortunate to have him return to the program. Jesse, thanks so much for joining us today.
It's my pleasure, Adam.
Hey, Jesse, it's always fun when you're on the program. Thanks so much for coming back on. I'm really looking forward to this discussion. Number of questions for you, but let's kick it off with the normal high-level question I like to ask you at the start here. What's your current assessment of the global economy and financial markets?
Well, I think we're in this in-between phase, right? I mean, it's monetary policy famously works with long and variable lags. We've had a very rapid tightening of monetary policy. And because we haven't gone immediately into recession, this idea of a soft landing, which always comes around at this point of the cycle, has gained some traction. It's even gone so far as, to people talking about no landing.
Right.
If you look back, I think The Economist had an interesting article on this where they pointed out the soft landing term, the phrase, dates back to 1973, when, we were kind of in that in-between phase there too, where the Fed had, tightened a bunch, recession hadn't started, but almost immediately, right after that phrase was uttered by the powers that be, we went into a very painful recession. Stock market cratered. It had already declined some in 73. 74 was the most painful part of that bear market. The term soft landing came back in, 2001. We saw a nice stock market rally into the spring of 2001. And people thought, maybe this tightening, the Fed, tech stocks had cratered enough, and maybe the Fed had done enough to kind of slow down the economy without creating a recession. That proved once again to be overly optimistic. Same thing we saw in 2007, even into early 2008, this idea that Fed tightening, had done enough, but not too much to create a recession. I think, the idea of a soft landing this time is even more ridiculous than in those previous instances. The reversal in monetary policy has been much more dramatic, right? A year ago, we were at 0%, funds rate, and the Fed was just starting to slow down and reverse quantitative easing. Today, we're almost at 5% on the Fed funds rate. So we've had a dramatic tightening. That doesn't, have an immediate repercussion on the economy, but it will. And, all of the leading indicators that I look at, and it's fascinating that everybody's looking at these lagging indicators, to say, well, look, the economy is doing fine. They're looking at GDP and they're looking at employment. These things are all, classic lagging economic indicators. So if you want to look in the rear view mirror, yeah, things look great, right? But if you're looking forward, you're looking at leading indicators, all of them are pointing to not just the high probability of recession, but a significant possibility towards the middle or third quarter of this year of a pretty significant one. So, I think that we're in this in-between stage where you have a level of optimism that's just not backed up by the, leading indicators.
Okay, great jump off here. So if we can, let's dig into this lag for a second, because I've mentioned on this program many times, but it's funny, right now, Powell is basically telling the markets, what he's going to do. And the markets are basically saying, we don't believe you, right? He's saying, I'm going to be higher for longer. We're going to take on pain. I'm not going to pivot early. I'm going to hang out probably for the full year if possible, once I pause. Markets completely not buying that right now, right? And so it may be a matter of the markets. I guess my question is the markets simply hearing what they want to hear and just kind of ignoring everything else. And it sounds a little bit like that's what you're saying, but let's zero in on this lag thing for a second, because Powell has been talking about the lag, right? But the markets clearly aren't hearing it, or aren't believing it, or are just ignoring it, right? But the lag, and I've heard different estimates on it, but it's sort of somewhere between 9-ish months to 12 months, which means we're only just now beginning to see the full effects of the very first quarter point rate hikes that the Fed did, almost a year ago. And we have the vast majority of all the tightening that's been done to date still to slam into the economy. And it's going to be slamming in these rolling waves, right? Because it was months between each of those rate hikes, right? So we know we kind of almost have this beating coming to the economy. Right. Yet everybody, like you said, is looking at the lagging indicators and saying, "Oh, these are the green shoots we're all waiting for. Everything's going to be great. We're going to have the soft landing, the no landing, or I'll call it the Sam Snead landing." Sam Snead was a famous golfer, and he bragged that he could land a chip shot on the green like a butterfly with sore feet. Right, like just this incredibly gentle landing, right? Yeah. So, I mean, first, how important is the magnitude of the lag effects that are coming here? Markets, like I said, is saying, I'm not worried about them. Is that the wrong attitude to have?
It's it's probably the most dangerous attitude to have for investors, because you look at this point in the cycle, and I'm going to transition from kind of macroeconomic stuff to just pure technical analysis. If you look back at the major stock market peaks, going back to the 73, 74 top, you have kind of a rolling over of prices where you kind of form a range of prices. You break down below a support level, you rally up to test that support level from below. In technical analysis, is probably the clearest, most picture perfect bearish setup you could imagine. I call it the long kiss goodnight, because you're basically kissing former support, now resistance from below. And it's just kind of like the kiss goodbye before prices roll over into the most difficult part of the bear market. Now, I just wrote a report on this topic because it goes back to when I, almost 30 years ago, I had just graduated college. Before I went to work at Bear Stearns, I thought I might, interview as a script reader for Hollywood. I interviewed with an agent at William Morris, and he gave me some scripts to read and said, "Tell me what you think of these." One of them was that movie, The Long Kiss Goodnight, with Samuel L. Jackson and Gina Davis, and it hadn't come out yet. So I read the script, I handed it back to him, and I said, "This is crap." He gave me a handful to read. I said, "This is crap." And he goes, "We actually just paid $4 million, a record at the time. We just paid $4 million for that script, and it's going to be our biggest budget project over the next few years." So clearly I didn't get the job. Yeah. But I felt vindicated to an extent, because the movie didn't bomb, but it certainly was a disappointment, for Hollywood. It didn't make nearly as much money as they had hoped. And I think that's kind of a good metaphor for investors today. Is they're buying stocks, you have retail flows coming into these big tech stocks. And we can talk about the unique characteristics of the paradigm shift in big tech today, but you have them coming in thinking this is a terrific buying opportunity. And really what's going on is they're kissing their capital goodbye over the next few months, because I think this is a classic bear market rally right up to these key resistance levels, which represents, I think, a terrific selling opportunity. And so that disappointment that Hollywood felt over this screenplay, I think, is a good metaphor for what investors are going to feel when they realize this wasn't a wonderful buying opportunity at all. In fact, it was a classic bear market rally and an opportunity to lighten up, a gift really to bearish investors to reduce equity exposure.
All right, yeah, and I think people forget, like, that is the role of a bear market, right? It's to punctuate itself with these ferocious bull rallies inside the bear market that suck everybody back in, right? That make them feel like the all clear has been given, and then the bear returns and mauls them even more, right? And we've had some, quite veteran investors and financial advisors on this program who have been through many market cycles. And they've said, look, a bear market ends when nobody wants to touch a stock again, right? You have that sentiment capitulation, right? Where people have just said, I've been so badly burned, I don't even want to think about getting back into stocks. And they've said, we just haven't seen that this cycle round, which is why one of the reasons why they're so confident that if indeed this is a bear market, it's got further to play out here. You're sort of nodding a little bit as I'm saying that, but we've had people looking for the bottom to jump in. We haven't looked at them, in walking away in disgust.
Yeah, I've never experienced personally or even heard of a bear market low that bottoms with record retail flows into the most speculative names in the market and bottoms with record call buying in stocks like Tesla. And in general, I mean, we saw just a week or two ago, the volume in calls hit an all-time record. And so that type of speculative, to me, this is a little bit of an echo bubble, right? You had the bubble, the meme stock blow off in 2021 and tons of money just flowing into these things. And this little thing I think we've seen since the beginning of the year is kind of an echo of that behavior. We're seeing a lot of these meme stocks take off again for no reason whatsoever, other than the fact that there's tons of call buying, creates a gamma squeeze, creates short squeezes, shorts have to cover, retail investors are emboldened. I mean, classic bear market kind of stuff, really.
Interesting. Yeah, I've been saying recently, we've been trying to give attention to both sides of the argument here, but I have recently kind of resorted to saying I can't really make a bull argument except that stocks are going up.
Yeah, I mean, the only
beyond the tape itself, it's hard.
Yeah, that I can think of, and it's one that I try and keep in mind, is the possibility of what the Austrian economists have called a crack up boom. Mm-hmm. You have inflation takes off and out of control, and investors bail out of dollars into almost anything else to try and avoid the ravages of inflation. Now that is, I think we saw, corporate revenues take off as a result of inflation of the last couple of years and other, dynamics. But I don't think that, we're seeing that just yet. I mean, that may be down the road, that type of an inflationary thing.
Especially because we're seeing disinflation right now, right? Like exactly. You would expect that type of crack up boom if you were seeing continued inflation where the rate of inflation was growing, right?
Right.
Yeah. All right. Well, look, so I guess first, just going to put you on the spot and you're making it clear you're prognosticating here. So I'll let you come back on the channel and change your mind if you like. But do you have confidence in Powell's higher for longer?
I think we have to talk about this concept of hawkishness, right? I think everybody said the Fed is so hawkish, and it's true that they have raised rates dramatically, but we have to know that this came from, one of probably the most dovish policy. I mean, absolutely the most dovish policy we've seen in our lifetimes.
Right. I mean, lowest interest rates in recorded history from what I've heard.
Yeah. And you listen to people like, Stan Druckenmiller and whatnot, and they say, inflation's never come down without the Fed funds rate going above headline CPI. Mm-hmm. So, we're 6.4 whatever on CPI, and we're still not even 5% on Fed funds yet. So, I think, yes, that, the Fed, I do think Jay Powell wants to keep rates higher for longer, but I think we're already starting to see signs of distress. These are some of these other leading indicators. We're seeing corporate bankruptcies hit the highest level since 2010, in the wake of the financial crisis. We're seeing consumer auto delinquencies, same thing, highest level since 2010. We're already starting to see cracks in credit. And I don't think Powell is, there's a big fiscal discussion here too, where we're already seeing, fiscal revenues go into decline.
Right.
We have a 5% fiscal deficit to GDP, and the budget office tells us that's going to be just growing indefinitely. I mean, into the future without a recession. We get another recession, we could see another 10-15% deficit to GDP. These are the things that I don't think we can afford as a country. And so, what Powell, I think, really should be trying to do here is, raise rates even higher, create a recession that really does put the nail in the coffin of inflation, and then bring rates right back down again, because we can't afford higher interest rates. What this, I think, boils down to is, I think we're going to see negative real interest rates for a long period in the future. I think that's probably one of the safe bets. I recently wrote a market comment about central bank speed wobbles, because I think that's what we're in. If you've ever, ridden a bike or a skateboard downhill really fast, you know what the speed wobbles are.
Yep.
You get to a point where you start oscillating and you're going to crash, right? If you do not take very calm, collected action to kind of bring things back under control. And I think that's where we are in terms of the inflation picture and central banking. Is inflation and the economy are oscillating faster than monetary policy can react to it.
Mm-hmm.
Right? Monetary policy works with a long lag.
Right. And sorry to interrupt, but not that we have a great track record of monetary policy really ever being ahead of the game.
Right. Yeah. And I mean, the Fed fell so far behind the curve when this inflation picked up that now they're ramping up, and they're probably, stepping on the brakes too hard. I think they're going to create a recession this year. And then they'll probably have to cut rates again, very much like in 74, 75, and allow inflation to take off again after that. And they're just going to be in reaction mode. And so, 40 years ago, whatever, Paul Volcker got us out of this situation, just like an experienced, biker, cyclist would, by, very calmly, kind of bringing your body, in line with the bike and allowing the speed wobbles to kind of just work themselves out. But he raised rates to, 20% or whatever, and held them there, and created a very painful recession and all that. And I don't think Jay Powell even has the ability to do that. So I think we're in this period of, like I call it, central bank speed wobbles, where we're going to have inflation spikes, we're going to have recessions, we're going to have all these types of things. And I don't think we have a Fed that has the will or the ability to really effectively deal with it. So I think it's going to have to come back this time to fiscal authorities to rein in the deficit somehow. And that is very, very problematic.
Sorry to laugh.
Markets in the economy, right? I mean, this is why I think Jim Grant phrased it best recently. He said, voters, the reason we have inflation is voters vote for it, politicians, and implement it, and central bankers endorse it. And in a democracy like we have, everything kind of trends in this direction. But it probably will get painful enough to where we're going to have to make some choices here, down the road. But I think in the short, over time, the real, I think the conclusion that I have the most confidence in is that we're not going to be able to raise interest rates up to levels that are commensurate with the inflationary type of environment that we have in a sustainable way. And so we're going to have negative real interest rates for a prolonged period of time. And, that's a dramatically different investment environment.
In tandem with that, do you expect higher inflation than we've had?
I mean, it's absolutely possible, right? I mean, what I think the biggest worry for the Fed, and it should be, and the biggest worry for all of us, is if the markets, if, currency markets, if, asset markets come to the conclusion that Powell doesn't have the tools, have the ability to really deal with inflation, that's when things will get problematic. That inflationary mindset will take hold, psychology will take hold, and the dollar could really suffer, and we could have that type of a crack up boom that Austrian economists kind of warned about.
Yeah, and I'm not even necessarily talking about a crack up boom, but when you say negative real interest rates, that basically means that that's Fed funds rate less CPI is negative, right?
I mean, across the curve, right? I think
right.
even, the 10, 30-year treasuries are not yielding as much as the sustainable inflation rate, whatever that is.
Right. So if we're negative, we could be negative, with a massive crack up boom that's going on, although the Fed would really have to be, but we could also be negative just hanging out at I mean, we could hang out at 5 and inflation could hang out at 6, right? And we'd
Sure.
still be negative, right?
I just don't think we can fiscally afford to hang out at 5 for very long.
Well, I don't think we can. Yeah.
So the interest expense, that associated with that becomes problematic. And so this is where, if we're going to maintain 5, 6, 7, 8% deficits, and the debt's going to grow that rapidly, and we're going to have to pay a 5% interest rate on that, you get into, this is, when you have Larry Summers, talking about potential for a debt spiral, and you have, a former Treasury Secretary, right, talking about these risks. These are things people have to pay attention to. I am not an economist. I don't know, but I understand how a debt spiral happens, and I think that the best case scenario here would be for, and I think this is why people like Mohamed El-Erian have said, I'm really disappointed the Fed didn't keep raising at 50 basis points, because it suggests Tom Honig, former,
Fed governor,
FOMC,
or Fed president,
Fed president, was saying that the fact that they downshifted to 25 tells you that the bias is towards easing. Still, they're still not. I mean, the Taylor rule says they should be at 10. And we're not even at 5 yet. So there are all these problems with with where we're at. I mean, you could still say we're still not hawkish enough. And I think that what would have been way better is if Powell had gotten ahead of this thing and raised and truly erred on the side of hawkishness. Now that they're not, it opens up these possibilities of a debt spiral and things which are frankly, frightening. I don't know how to put any probability on it. I just know that I better be aware of it in terms of how I'm managing my money.
All right, absolutely. And we're going to get to the money management part in a bit. But reason why I'm zeroing in on this is when you said you didn't think that Powell was going to be able to necessarily go higher for longer. I know it's multifactorial, but I believe it's primarily the debt concern that's got you most worried.
Yep.
And I want to contrast today's environment to the 70s, because back then we had a much smaller debt burden, right?
Oh, yeah.
Much smaller debt to GDP. I mean, the national debt was infinitesimal compared to today's, right? And people forget that in just the 12, 13 years from the great financial crisis, the US federal debt went from something like 9 trillion to over 32 trillion or whatever, where we are now, right? So we're so much more limited now because of the debt burden, right? And the economy's become a lot more financialized as well. So to your point, you're like, I don't even think the economy can sustain at 5% or higher Fed funds rate. It very well may not be able to here. So what I hear you saying, and correct me if this is wrong, is you are saying, I believe you're saying, which a number of other folks in this channel have too, is I think Powell is serious about higher for longer. He just might not be able to play that playbook out as long as he would like to, because something systemic is going to break under the weight of these higher interest rates that he's going to be forced, his hand will be forced to rescue. And I'll let you respond to that. But to me, what's so backwards about the market's current thinking is the market is saying, yeah, Powell, we don't think you're going to do higher for longer. We think you're going to pivot sooner. And a pivot's going to be awesome, because then we're going to go back to the world we had 2010 to 2021, where I think the reasons, if Powell is forced to pivot for the reasons that it seems that you think he is, that's going to be crisis. That's not going to be a bullish environment for stocks. It's going to be pretty terrible.
Hey, absolutely. That's a great point, is if you look at stock market returns after the first rate cut, they're terrible. They're terrible. The Fed was cutting all the way through the financial crisis. The Fed was cutting all the way through the dot-com bust. And so this idea that investors have that a Fed pivot is going to be bullish this time is asinine.
Yeah, and especially, sorry for interrupting you, but especially because there's still that, quarters long slamming into the economy effects of all those rate hikes. So it's like, you're putting your foot in the gas, but you still have all this braking that's hitting the system. So for a good long while, it's just collisions. You're not making progress bringing things back up.
Yeah, absolutely. So there's two indicators, leading indicators that I pay very close attention to, that I think are, one of the reasons they're so valuable is very few other people actually look at them. One is you can create a composite of the dollar, interest rates, and oil prices, and this composite has a 2-year lead on the economy and corporate earnings. So when you have the dollar rising rapidly, you have interest rates rising rapidly, oil prices rising rapidly, it results in a recession and an earnings bust roughly 2 years later. And you can say the same in reverse too. When you have the dollar tanking, interest rates tanking, oil prices tanking, that creates a real boom 2 years later for earnings and the economy. So we really need to start, that kind of, I think, emphasizes that point of, once interest rates start coming down, it takes a couple of years to really work its way through the economy. And that's because you think about, corporations refinancing and all those kinds of things, right? That takes a long time to have an effect. People refinancing mortgages or whatever. The other indicator that I mentioned is the corporate insider sell to buy ratio. So I track over a 12-month time period. My ratio is different than some you might see that include 10% owners. If you own 10% of the stock outstanding in a company, you technically become an insider and have to file your trades. I don't find that trading as valuable as just officers and directors at these companies. And so I isolate them. When you see that sell to buy ratio, it's almost identical to this other indicator that I mentioned, which is the dollar, interest rates, and oil prices. And into late 2021, we saw that sell to buy ratio just go off the charts. The amount of insider selling was humongous. We saw Jeff Bezos unload just tons of stock. I mean, Elon's been selling all the way down, but you've had very little insider buying as well. And that's one indicator that I'm watching closely to see for more sustainable stock market lows. I'd love to see corporate insiders come in and start buying their own shares. They're not doing that.
They're not doing that.
At every good, even the good buy the dip opportunities over the last 10 years, you've seen insider buying pick up at the lows. We haven't really seen that at all this time. So that 2021, late 2021 selling tells me that it's interesting that it lines up almost perfectly with this other indicator saying the latter half of this year is when we need to be worried about the economy and corporate earnings. Now, once we see those indicators reverse, we see tons of insider buying. We start seeing, the dollar, roll over even harder than it has. Interest rates come down. We haven't seen interest rates come down at all yet, and oil prices come down, usually by way of recession. Those three things, and paired with some insider buying, will tell us that the next 2 years are going to be much more bullish than the past two. We haven't seen any of those things yet. So, to me, the leading indicators aren't at all close to confirming the idea that we're seeing an important bear market low.
Okay. So, again, we'll get to the market in your portfolio positioning in a little bit, but on the economy side of things, from everything you're saying, it just sounds like you're saying we got to prepare for recession, likely this year. And I think maybe you said middle of this year or Q3 of this year. Is that sort of your expected timing right now of when it's we're not arguing about it anymore. We're all agreeing we're in one.
Yeah, like I said, those indicators have kind of a 2-year lead, which is, kind of a rough, you'd probably create a 6-month window for it. So I'd say that's the second half of this year. It's kind of what those things are pointing to. So third, fourth quarter.
Okay. And between now and then, we GDP actually wasn't bad in Q4. GDP now numbers are above they're like 2.5% or something like that, I think, last time I saw them. China's obviously opening up a little bit. Are we just going to sort of sputter along, maybe even have some little false hope here, maybe a long kiss goodnight on economic growth as well?
Yeah, I mean, obviously the reopening of China and is a bullish factor for the global economy, although it's not been driven by the same factors that have typically driven, global growth. It's more Chinese consumer led. than kind of infrastructure construction types of things. But and then I think there's been some seasonal factors too, right, where the weather's been warmer than usual, and that's helped a lot of these retail sales and things. But I am not, like I said, I'm not an economist. I'm not, I can't forecast quarter to quarter GDP. I just know that there is risk of a very weak second half. Now, I would point out too that, right, the stock market is a discounting mechanism. And as companies continue to tell us, right? I mean, we saw the worst earnings guidance, since the GFC, in this last quarter. We have companies like Microsoft, and we can talk about big tech because I think that's an important issue. But Satya Nadella saying the next 2 years are going to be really difficult for the industry. When you pay attention to those kinds of things, that's all confirmation of these macro kind of indicators that I'm pointing to, and that's important to have that kind of anecdotal confirmation from some of the most important companies in the market. So, I just think that everything's pointing to that second half weakness. How we get there, I have no idea. I think that a lot of people were looking at the 2008 analog for price analog in terms of what the market's going to do. I think it's very unlikely we have another type of financial crisis. The banking system's a lot safer. You ask somebody like Steve Eisman, he's like, that we're not going to have another financial crisis. The banks are in much better shape, not nearly as leveraged as they were. We don't have the type of problems in housing like we did 15 years ago. So yeah, it's going to be something different this time, but generals like to fight the last war, so to speak. And so people are expecting, if we're going to have something, it's going to look like the GFC. I think it looks more like 2001-2 recession.
Okay. And the 2001-2 recession, it wasn't as systemic as what we saw in 2028, but it still hurt a lot of industries. So let's talk about big tech for a second, but I do want to preface it by saying I've been talking a lot about the layoff risk that a recession would bring, and one of the reasons why I do that on this channel is just to keep our eyes focused on the human cost of a recession. It's not just stock prices go down. It's oftentimes that millions of people lose their jobs and they have real problems at that point in time. And some people, to date have been quick to dismiss the layoffs that we've seen because a lot of them have happened in tech, and they've just said, oh, those are the, big bloated tech companies. They can afford to shed these people. They just overstaffed, and it's not really a contagion yet. But we're seeing more and more examples as the year progresses here of many other companies in many other industries laying people off. Walmart and Home Depot just released bad earnings results and forward guidance. So we're seeing retail really begin to take a hit here too, which I think is much more concerning because it really shows on a broad-based level that there's weakness in consumer spending, which we all know is 70% of GDP at this point in time. So let's get into big tech, but I just wanted to sort of set the table here that the issues that we might just talk about here in big tech are not going to be unique and limited to big tech.
Well, one of the macro themes that I'm paying close attention to, I think Home Depot and Walmart. I mean, Walmart has been raising, its starting wage dramatically over the last few years. Home Depot announced that they're going to invest $1 billion into wages and these types of things going forward. So I think one of the themes, macro themes to keep a close eye on is over the past, 30, 40 years, we've seen the labor share of income drop dramatically to record lows, right? Corporate profits off the charts, right? Especially through the pandemic, just ridiculous. We've never seen such corporate profitability. I think demographically, we're at an inflection point where we're going to start to see labor share structurally climb again. Just because the proportion of the working population to the overall population is shrinking, right? Mm-hmm. We're an aging society, and you have fewer people to do the same amount, do even more work as the population grows. That is very bullish for wages. Bullish. It's very inflationary, and it's something that we haven't had to deal with. Deglobalization only exacerbates that trend. But to get back to big tech, I think there's, what reminds me of the 2001, 2002 bust is we had a kind of a Y2K phenomenon during the pandemic, where if you remember back to Y2K, everybody thought, computers and servers and everything were going to stop working when the calendar rolled from 1999 to 2000. And so we had this huge upgrade cycle. Everybody had to go get new computers, new servers, all this stuff. Turned out to be a non-event, but it created a huge boom in product, demand for products leading up to the 2000 stock market top. And then that boom left a huge vacuum of demand in its wake. And that was
right, because we pulled all that demand forward into the previous millennium.
Exactly. So everybody had upgraded, whatever. Oh, I don't need another server for 5 years. So, Intel, everybody just got, hammered. Sun Microsystems. I mean, the stock prices got destroyed because they became so overvalued, but also because the business, growth went nowhere afterwards. And I think during the pandemic, we saw something very similar, where all the work from home, whatever. I mean, we saw it with Peloton bikes. We also saw it with laptops. We saw everyone upgrade their cell phone. I'm working remotely. What do I need to do that? So there was this huge upgrade cycle. And right now we're seeing the flip side of that. But at the same time, I think what's different than 2001, 2, and it's even, I think, more bearish, is when you think about these big tech stocks, you think about the cloud and you think about digital advertising, whatever, I think it's helpful to think of them as being in the picks and shovel business, right? We've had the Fed created a gold rush, lowered interest rates to zero, printed a bunch of money, and enabled a bunch of zombie companies to live that otherwise shouldn't have. Really, saw the startup economy just boom like never before, created all of this extra economic activity that otherwise probably wouldn't have been there, pulling demand from the future and enabling a lot of these companies to thrive when they otherwise wouldn't have. So I think it's important to think about how much of big tech's business, how much digital advertising, how much of the cloud catered to those industries and companies that are only sustainable in an extreme monetary environment.
Right.
Right. If we're now seeing a normalization of monetary policy and normalization of interest rates, how many of those zombies are going away? How much of the startup economy is going away? And I think what we saw with big tech's cash flows in the last couple of quarters is potentially a warning sign as to how big of a problem this is. For the last 10 years, we've seen, the aggregate cash flow of the top 8 big tech stocks. They make up 50% of the NASDAQ 100 and 25% of the S&P 500. These top, Apple, Microsoft, Google, et cetera. We saw their cash flow fluctuate between, 0 and 20% growth for the last 10 years. In the first quarter, we saw aggregate cash flow in all these companies drop to negative 25% year over year. That hasn't happened in the last 10 years. And to me, that's a wake-up call saying something has dramatically changed for these companies. Now, like I said, part of it is the hangover from the pandemic. That's, kind of a demand, a unique demand situation. But I think part of it is too, a lot of the digital advertising was maybe driven by, companies, DoorDash and Uber and a lot of these things that maybe aren't sustainable business models. And so that, proportion of the advertising is potentially going away for good. At the same time, how much of the cloud business was driven by the startup ecosystem and saying, okay, we need to do all this stuff. We need to put it all in the cloud. Amazon Web Services, catering to that. And how much of those businesses is going to, go away permanently if we have a permanently higher interest rate and inflation environment. Right. So I think that, we're potentially seeing the early stages of a paradigm shift for big tech, which is, the title of that report that I wrote was The End of the Gold Rush. If we're seeing the end of the monetary gold rush, it has implications for the long-term cash flow growth of these big tech stocks.
Great point. And I imagine then that maybe in the next cycle of the market, post-market correction, it might not just be, you're not sure it's going to be the same playbook where all the money just goes back into the big tech companies again. There might be a new leading sector next time.
And that's the lesson of bear markets, right? I mean, I can't, in my personal experience and reading through market history, I don't know of a major bear market that didn't result in a change in leadership from the prior bull market to the next bull market. These things go in cycles, and it comes back to the capital cycle, right? When you have a sector that is the focus of tons of capital going in, returns for that sector come down for a long period of time, right? Because it's overinvestment, malinvestment. You create lower returns for a prolonged period of time, right? We saw this in energy. Right in the wake of the financial crisis, all the energy companies, fracking companies, were able to borrow money really cheaply. They invested in supplies, right? It was oil supplies boomed, and they had this major bust, for almost the last 10 years, really. I mean, from 2014 until, 2020, we had a really painful capital cycle where energy was starved of capital for a long period of time. That created, a strain on supplies, which we're now dealing with in the energy sector, which will probably create a secular bull market for these stocks for a period of time. But what set the stage for the bull market in technology over the last 10, 15 years was the technology bust. And they were all starved for capital, right, for a period of time from 2002, 3, 4, 5 to 2009, 10. These companies were starved for capital through that whole period. So that created the wonderful returns that we had over the last 10, 12 years. Now we're seeing, we had with like the startup ecosystem and all these things, there was so much money. Look at SoftBank, right? So much money poured into so many different companies that returns are not going to just be terrible for 1 year. They're going to be poor for a number of years, I think, for these sectors.
Okay. So it sounds like you would say if somebody's got heavy exposure to big tech or some of these sectors, that they should perhaps use this long kiss goodnight to reduce exposure there, try to capture the gains that are there and prepare for both the down cycle and maybe shifting to a different horse in the next up cycle.
Absolutely. And that's why I point out their weight in the indexes. Like I said, those 8 stocks are 50% of the NASDAQ 100. They're 25% of the S&P 500. So if you're a passive investor today, you're massively overweight big tech. And so, I know the whole point of passive investing is to not think about these things, but I think, if you are an investor who thinks that thinking about these things is important, then I think there are alternatives that are close alternatives to passive that are much more effective ways to invest still in a diversified and low cost way. One of those is fundamental indexing. Research Affiliates has come up with the best alternative to passive investing that I've seen, which is let's create an index, but instead of using market cap weighting, let's weight companies based on their sales, their book value, these fundamental things that make sense. And it systematically means that you're going to underweight overvalued companies and you're going to overweight undervalued companies. And if you just look at the top holdings in the Research Affiliates fundamental index compared to the S&P 500 is dramatically different. And I think that's a very good alternative for a lot of investors.
That's pretty fascinating. It's called fundamental indexing?
Yes.
Okay. Oh, that's super cool. All right. And we are getting to the investing part of this conversation, folks, I promise. There are one or two other quick macro things that I'd like to ask you, and then we'll get into the market outlook part. So just getting back to layoffs for a second, because again, that's I think one of the true measures of the human cost of a recession. I know you're still prognosticating and looking into your crystal ball as best you can see. But what sort of magnitude do you put on your expectations for layoffs? Should we get the recession that you think we're most probable to get from here?
It's a good question. I think we should probably already start seeing it. There are a bunch of unique factors, and this ties into the inflation, discussion too, where we're seeing, housing is right. Activity has dropped off a cliff, but we're not.
And that's where I was going next. So just blend that right in.
But we're not seeing the layoffs in housing and construction. And I don't know what that's related to. I know we have a structural, shortage of housing. And so maybe a lot of the home builders are reluctant to let go of people and then have to rehire them back, later on. I think also there's this reshoring trend, which is important to pay close attention to. In addition to the massive infrastructure, program that we have, over the next few years. And we just don't have enough. I think the Financial Times estimated we need 500,000 more construction employees just to fulfill the infrastructure plans that we have over the next few years.
Yep,
So,
sorry to interrupt. 546,000 to be specific, because I pulled that chart off of your Twitter feed.
Yeah. So there are these dynamics, right, where you have, all else being equal, the pain in housing should have already resulted in layoffs and things. And the fact that home builders aren't doing it is an important sign. It could be related to infrastructure, could be related to reshoring. Maybe you just repurpose a lot of these people towards, building semiconductor production, plants and, these other types of things that, bridges and things that we need work on. I don't know, but so I don't know how the unemployment picture plays out. I know that a lot of indicators right now are pointing to rising unemployment. I also know that Jay Powell needs unemployment to go up in order to address inflation. Right?
And he has been super clear about that.
Wages.
Yeah, he's been super clear about that for almost a year. Right.
Yeah.
He's basically saying, you translate what he's saying, I'm declaring a war on jobs. They got these two mandates. Jobs are at near record lows, and we have this wicked big gap between job openings and applicants. And, my job is to bring demand down. And one of my measurements is going to be closing that gap, meaning I'm going to be destroying jobs.
Right. Yeah. And he can't come out and say that directly, but that's essentially what he's saying is.
Yeah. He's got as close to that, I think, as he's allowed to say.
Right. Absolutely. So, I don't know exactly how that plays out. I know that, a lot of this, comes back to corporate earnings and corporate investment. And when you look at, the small business readings and things like that, it all points to corporate profits being pinched. That is going to put, a pinch on corporate investment. They're going to say, okay, we're going to back off on investing in different things, whatever. That is why we're seeing these layoffs, because, we're seeing, the cloud business slow dramatically, right? So Amazon doesn't need so many more people to go build these data centers and all these kinds of things. And so I think this plays out like a normal cycle, but there are some unique characteristics that are those inflationary dynamics of reshoring of production and things that kind of throw a wrench into it and make it different.
Yeah, it's super interesting. And obviously, the more people who get laid off, the harder consumer spending gets impacted, because people either don't have the income or they're afraid of losing their income, right? So they're tightening their belts. Yeah. Let me connect a few dots here. I think you're saying, look, if you work for a paycheck for a living, you should probably start doing some game planning now of just what would I do in case my hours got reduced or I got laid off or whatever, right? You're nodding as I'm saying this. It's interesting, there are the reshoring factor is interesting. And there's two articles I pulled from some of your recent writings. One was an article that said that Kyocera, which is a well-known Japanese corporation, has come out with the statement that China is no longer viable as the world's factory. Wages have gone up, and given everything that's going on in China, it's getting more and more difficult to export from China to other places, right? At the same time, the world is, like the US, is saying, hey, we don't want to have all of our manufacturing done in China anyways for a variety of reasons. We're going to start pulling that home. That is inflationary, like you said, right? So that is going to contribute perhaps to keeping real interest rates negative for a prolonged period of time. But it's also just going to continue to crimp profit margins at corporations, and it's going to crimp consumer budgets because things are going to cost more as a result. The wage input is going to be higher. But you have, the spending that's being done kind of at the federal level, right? Those infrastructure bills that are going to need people to build that stuff. So that is going to support some part of the economy here. What's interesting is in the construction world is I don't think that that's good for residential housing. In fact, I think it's probably even bad for residential housing to a certain extent, because for the building that will happen, even if it's reduced, the labor cost for that's going to be higher still, because they're competing with the government, right? The government sweet contracts out there. Most construction workers are going to say, I'd much rather build the fab plant because I get paid a much higher wage than, Pulte Homes is going to pay me, right?
Absolutely. Yeah. And I think these are the secular forces of inflation. And when you start to talk about them and think about them, you realize maybe Jay Powell has no hope, right, in addressing these issues. When you really think that the biggest, I think the two biggest disinflationary forces of the past 30, 40 years were demographics and globalization. Right?
Yeah.
We had, especially after the financial crisis, right? People's finances were decimated, right? They lost money in the stock market, they lost money and their housing values went down. So you had tons of baby boomers that stayed in the workforce longer than they intended because they had to rebuild their investment accounts, their savings accounts. They had to hope that their value of their home went up. And so the labor market stayed bigger than it otherwise would have been as they all stayed in the labor force, right? And that was an important...
But helped by monetary policy, right? By keeping interest rates so cheap, it let economic activity bloom, right?
Yeah.
So,
and then when, the Fed printed, tons of money and real estate and stock market went through the roof and, a couple of years ago, they all said, hey, thank you very much. I can retire now. So they all left the labor force, right? And said, my retirement account has been, made whole again, if not, doubled, tripled, whatever. My value of my house is at record, highs. I can afford to retire. We left the labor force. And that kind of, cyclical dynamic, I think, hid the fact that the labor force was structurally shrinking relative to the overall size of the population. At the same time, since the, early 80s or whatever, we've been shipping jobs to China. That has boosted corporate profits. They've said, we don't need, unionized workers here in the US anymore, right? We can ship, production over to China and save, cut our costs in half. That trend is now over. And that was an important, point by, Kyocera pointing out that, the cost of producing in China has now gone up so much that it's really not as attractive as it used to be. And there's all kinds of political problems now and supply chain problems potentially that, you risks that you take by doing that. And so, the fact that globalization is done and this demographic shift is happening at the same time means that secular inflation trends have reversed from being disinflationary to inflationary. And, that has nothing to do with monetary policy. What monetary policy did was by, shooting M2 to the moon for the first time, by the most dramatic, moonshot we've seen since World War II, is they threw like the monetary fuel onto this already, macro inflationary fire, and so it's, may you live in interesting times is famously a Chinese curse.
Yeah.
And I think we are cursed to live in interesting times today in regard to a lot of this stuff.
All right. Well, look, so many more threads I'd love to pull with you on the macro side, but I'm just looking at the time. We'll just have to save them for next time. Let's go over into the market outlook section. I guess real quick before we do, Jesse, unfair not to give you any time to talk about it, but is there any other major macro issue we haven't touched on yet that you think is just worth people having on their radars?
I think, the one that I try and emphasize is, are these big tech issues, because I think the popularity of passive investing has gone so large in recent years. I think people don't necessarily appreciate that they're making a huge bet on these big tech stocks. And, that's worked great for 10 years or so. But I don't know. I don't think that's going to be a great bet over the next 10.
Okay. All right. Well said. All right. Well, look, now we're finally at the long-awaited market outlook point. So I got to imagine that if you're expecting a bad recession, or at least a material recession by mid-year Q3, that at some point the currently somewhat overly sanguine stock market is going to get the memo, right? And is going to say, all right, you know what, we were really hoping that we were kind of returning to salad days and that Powell was going to pivot soon and the unicorns and rainbows were going to emit forth. Probably not going to happen now. I guess we got to start repricing for what the macro data is now showing us is probably rougher times ahead. What do you expect the markets to do over the rest of this year?
Over the rest of this year, I think
our interview with Jesse will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And don't forget that Wealthion's online conference is now less than 1 month away. Lock in the early bird price discount before it goes away by registering for it at wealthion.com/conference. And finally, if the challenging macro and market outlooks that Jesse has detailed in this interview have you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends, risks, and opportunities that Jesse's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Jesse Felder.